All right, folks. Oh, here we go. Question number 4. Cohen Corporation sold a truck full of rocks to UNCP. It was sent FOB shipping. The merchandise became lost during shipment. Who owned the rocks when they were lost? Okay, so remember it was sent FOB shipping. Okay, FOB shipping. All right, so go ahead and answer this question. Make sure you write it down so you can use it on your quiz. Okay. All right, now when we're recording sales, this is sometimes a little bit confusing for students. So let me show you here. Okay, we'll go to the pen. All right, so remember when you make a sale, there's two components. Okay, there's two components. One is the sale. So in other words, this one right here, this is the sale. That's the sale. This part has to do with the inventory. So if you take a look here, in this case, they had revenue, $800, right? They sold $800 and they got cash, $800, right? But remember, all that $800, that's what they received for selling the inventory. But they also have to account for that inventory. So notice they have cost of goods sold. This is an expense, right? And then they lower their inventory by $700. So basically what happens here, this would be $800, this would be the revenue, right? Minus the $700 cost of goods sold. And so they would have gross profit of $100, okay? So you got to remember, you need both. When you sell something, and by the way, to let you know, this is done automatically. Remember when we mentioned Walmart, that perpetual system? So as soon as that thing goes beep, they know we had a sale, we have to lower inventory. In other words, it's all done automatically behind the scenes, okay? Now, eventually you do have to check on your inventory to make sure, your numbers match up and what have you. And they do that every so often just to make sure. But remember, most of this is done through the computer, okay? So there's the selling price, and there's the cost of the cost of goods of the inventory, okay? So here, let's look at an example. Walmart sells 4 mountain bikes selling at a price of $200 per bike for a total of $800 in cash. Bikes had previously been recorded in Walmart's inventory at a total cost of $175 per bike for a total cost of $700. So notice what happens. Here, our cash goes up, it's an asset, goes up by $800. Our inventory, because we sold the bikes, goes down by $700. Our sales revenue goes up, and our cost of goods sold goes up. It's an expense, right? Like I told you before. So this is the journal entry that you would see. There's the first journal entry. This is the sale, and this is the one for the inventory. And by the way, sales revenue, this is on the income statement. Cash, this is on the balance sheet. And cost of goods sold, this is on the income statement. And inventory is on the balance sheet, okay? And that is how we keep track of it, okay? So sometimes when we sell merchandise, something happens, it comes damaged, okay? All right, so take a look here. Let me put the highlighter on. And okay, sales return and allowances. That's what we're talking about right here. These guys, sales return and allowances. So the customer arrives in damaged condition, or it's not satisfactory, okay, for one reason or another. Normally, customer can return the item for a full refund, or sometimes what will happen is they can keep it and ask for a reduction in the price, okay, reduction in the selling price, and this is called an allowance. This is called an allowance. So I'll give you an example. Let's say one that's actually happened to me. We bought an oven one day. The oven came and it had a dent on the side, right? I don't remember how much the oven cost. I don't know, say $800, right? So we got this oven. When the oven came, we got it from Lowe's. When the oven came, it had a dent on the side. So then the question is, well, do you want to keep it with the dent on the side? Now, you know how an oven kind of fits in there, you don't really see the side, so you're not going to see the dent. But I didn't pay, I'm not paying $800 for a dented stove, right? So they asked me if I would take a discount on it, right? So, you know, it would depend upon the discount. And you got to remember, for the people that are delivering it, or for Lowe's, right? Let's say I say, nope, I don't want it, take it back. I want one without a dent. They took the time to deliver it, the cost of the delivery, the cost of the delivery guys. They got to put it back in a box. They got to put it back on the truck. They got to bring it back to inventory. Then they might have to, depending upon how it got dent, they might have to talk to the supplier. So it just makes sense to give a discount, right? So in this case, they gave me $100 off. So I'm like, okay, it only cost me $700 and I'm not going to see the dent anyway. But that's what a sales return and allowance is, okay? So let's take a look at an example here. It says, suppose that after Walmart sold the 4 mountain bikes, one mountain bike was returned to Walmart in good condition. Walmart would refund $200 selling price to the customer and put the bike back in inventory. So here, they're not doing an allowance, they're showing you an actual return. So notice, here's what happens, right? They refunded the money. They put the bike back in inventory. They're calling it a sales return and allowance. By the way, see this XR here? That's contra revenue. So it's lowering revenue by $200. And cost of goods sold is their cost of goods sold. They're lowering their cost of goods sold as well, because remember, now that cost of goods sold they had before, they're lowering it to put it back. So basically, you're reversing the part. Okay. So here you go, sales return and allowances. And again, this is a, put the pen back on. This is a contra revenue. Contra revenue right here. And then the cash is an asset and it's going down, lowering it. This is a contra revenue and it's increasing. Okay. Inventory, we're putting it back in inventory. It's an asset and it's increasing. And cost of goods sold, it's an expense and it's decreasing, right? Because we didn't sell it anymore. We took it back. Okay. All right. Now, sometimes at the end of the month, expected returns. What they're saying with expected returns, there's a month-end adjustment for expected returns. So what they're getting at is that some companies, they know if we sell 1,000 items, there's a certain amount of them we can expect to be returned. It's just, we've seen it historically over time. Okay, so what they do here, the refund has not yet been paid. It's only expected to be repaid. So notice it says here, the decrease in cash on the previous slide is increased with a liability called refund liability. So this is where they believe they're going to have it. Now what they're doing here, they're estimating the refunds. Okay, because remember, we want to try to put the most accurate numbers together. Okay, so remember, it's only estimated, and so they have this thing called inventory estimated returns. And the reason that they do this is because over time, like a company like Walmart, after a while you get to know approximately how much will wind up being returned. And so what you want to do is, for those statements that you're doing every month or every quarter, you want them to be as accurate as possible. So if you know you sell $1 million worth of stuff and $50,000 of it almost always gets returned, you should show it like that, because this way you're being the most conservative and you're giving the truest picture of what's going on. All right, folks, that's it for part 3. We'll be back with part 4 in just a moment.